Welcome to the Women's Money Wisdom Podcast. I'm Melissa Joy, a certified financial planner and the founder of Pearl Planning. My goal is to help you streamline and organize your finances, navigate big money decisions with confidence, and be strategic in order to grow your wealth. As a woman, you work hard for your money, and I'm here to help you make the most of it. Now, let's get into the show. Welcome back to the Women's Money Wisdom Podcast. Today, we always love having authors of new personal finance books join us, and today is going to be a great one. We are thrilled to have as our guest Ben Carlson. He is the Director of Institutional Asset Management at Ritholtz Wealth Management. He is the author of 5 books, including his latest, Risk and Reward, and the creator of a blog called A Wealth of Common Sense, as well as a podcast that I'm a fan of, the popular Animal Spirits podcast. Ben, welcome to the podcast.
Thanks for having me.
Well, and I should mention too, even though we have a national presence, a lot of our listeners are from Michigan, and I think you are as well, right?
Yes, I'm a member of the flyover states, just like you.
Perfect. Well, welcome, fellow Michigander, but national presence when it comes to talking about personal finance. Congratulations on the new book.
Thank you.
Tell me a little bit about why you decided to write what I think is a great, like a popular literature textbook, or not literature, but, like something you could pick up in the bookstore to teach you about history lessons when it comes to money in the framework of risk and reward.
I feel like I've been trying to explain the markets for the past 12 years or so since I started my blog, and figure out different ways of using data and stories and analogies and ways to do that in like plain English. And when you write for as long as I have, you're bound to get feedback. And I love getting feedback from people, questions, and there's also pushback and exceptions and devil's advocate. And hey, what about this? And did you ever think about this? And I think it's good to sort of stress test all of your own strongly held beliefs. And I wanted to show that even though I believe in the power of long-term investing, that if you look at the history of the markets over the last 100 years or so, there's just a laundry list of bad things that have happened. And I wanted to kind of show both sides of it. So that's why it's called risk and reward. It's like a yin and yang type of thing. And I wanted to show people that, yes, the long-term results can be magnificent in the stock market, but it's not easy. It's never easy, and it's never been easy to sort of stick it out through all the bad times.
So true. And I think we are sitting in a moment in time where there's been a lot of reasons to be scared, but there's also been so much to believe in when it comes to investing results. If you just wait a month or 2 or 3, then for most of the last 15 years, almost 20 years, you have been rewarded. And so one of the things I love about having had a chance to read the book is that it takes us over periods of time that newer investors haven't been exposed to. And so why do you think those history lessons matter, and what are a few of your favorites?
So William Bernstein is one of my favorite authors, and I try to kind of look at the similar things he does. And he said something along the lines of, the only black swans are the history I've never read before. And I was really attracted to history when I first got into this business, because I realized there was a lot of stuff about the markets I just didn't know. And I was never going, it's some of the things you have to experience, but I think also you can learn from history to understand like the range of outcomes. And it's funny, when I talked to my publisher about this book, he told me, like, whenever this book comes out, it's going to be a good time, because there's always something going on in the markets that is surprising or shocking, or catches people off guard to the upside and the downside. And yes, I wanted to go through things like the Great Depression in the 1970s and the lost decades and all these things that have happened. And you mentioned how things keep snapping back really quickly in this cycle, and they don't seem to last as long. But there's been plenty of periods throughout history where there have been these long, drawn out crises, right? And I think it's good to provide a reminder to people too, that this stuff doesn't always come back so quickly. And sometimes there are these really nasty recessionary periods and these bull bear markets that can last for a few years instead of a few months. And I think the one interesting one to me that was kind of seemed to match up with today is just the inflationary period of the 70s. And it's kind of one that not a lot of people talk about very often. And it wasn't something we really had to consider until we had inflation this decade, because it had been so long. It had been 40 years since we had inflation as high as we did. And I just think I was even a little surprised at like the psychological reaction to higher prices, how people reacted to that, and how badly it made people feel, how poor the sentiment got
Everybody's
because of
still
this.
pissed, right? Like
Yeah,
it's
oh yeah, it hasn't
because
gone
you're
away at
waiting for the
all.
prices to go back down, and it's like that's not the way inflation works. In fact, if that happens, we're going to have an even bigger, kind of problem on our hands because deflation is maybe the only thing worse than inflation.
Yeah, it's like inflation is the lesser of two evils. Obviously, you don't want inflation so high, but the psychology behind that, and I think understanding people at a time back then were pissed too, right? Of course, and thinking through how these things, like the human nature side of it, is the one thing that repeats over time. Like the market environments are always different. They're always completely different. People have updated knowledge and updated research and analysis and of what's going on in the market, but the human nature piece, that's the one that doesn't change.
Well, I'm glad you mentioned that updated research and analysis. I got into the business completely by accident in the late 90s and really learned about investing, first of all, on the job. I feel fortunate to have lived through a professional working for investment firms, financial planning firms in the last decade between 2000 and 2010 and seeing like the last vestiges of the first dot-com boom. Um, but I feel like it was easier to access this risk and reward framework. It feels like almost your book is a throwback because we have access to so much more information nowadays, and it almost obscures some of the most fundamental investing lessons about risk, about returns and rewards. Because there is just so much coming at you. You can go on, you can get more information on a um, very idiosyncratic, tiny part of the market, and you almost lose out on some of those investing lessons that felt a lot more accessible when there was less data in the world. So for that, I think for listeners, this is a great way to access some of the fundamentals of learning about becoming an investor.
It's funny. The thing that you always taught as a financial advisor is to tell your clients to ignore the noise. But that to me, that's impossible these days. The noise is everywhere. And we have these little supercomputers in our pockets that give us alerts and 24/7 news and social media. And so the noise is just constantly on. And so you're right. It's more important than ever to have a filter in place to figure out what really is important. I don't know who I stole this one from, but someone told me to quote that: "No one goes to church on Sundays looking for the 11th commandment." Right? You go because you want to reinforce these things that people should, and that's kind of what I try to do with my writing. You're right. It's harder than ever these days to not focus on like the minuscule details. And I think that's what leads a lot of people astray is that they hold on to these things that don't really matter all that much to like their long-term plan. Even in maybe it matters right now in this moment, but in 10 years they're going to look back and go, "Why did I ever spend so much time worrying about this little thing or paying attention to that data point?" And
Yeah,
it's hard to do.
there's so many distractions nowadays, and so I think one of your enduring lessons is to have frameworks, to have a process, to be patient, um, reduce your reactivity when it comes to investing. But all of that needs context and narrative. So I appreciate the storytelling and the back to basics that the book brings. And basics is good in this case. Actually, I think basics is advanced nowadays.
Yeah, you're right. I like to think that like I always say that simplicity trumps complexity, because I think it's easier to fool yourself with complexity, but it's also easier to like stray from the path when you have too complex of a financial plan or an investment plan. And I think it's easier to like rebalance into the pain when you have something that you understand, like what you invest in and why you invest in it, as opposed to something that you don't really understand. If you don't understand what you're investing in and you have like the new latest thing, even though it might be a good investment for someone else, if you can't personally, emotionally stand it, you're going to give up on it the first chance. And guess what? There's a million other things to invest in these days. So that's the hard part is that there are so many things that you can invest in that the temptation to change your portfolio and to change your plan has never been greater. And there's no barriers to entry anymore, right? There's no cost. The trading costs are at zero. Technology makes it easier than ever to just move things around. So it's much easier to just flip flop if you want.
Yeah, and based on history lessons, I mean, the future isn't predicted by the past, but based on history lessons, if you have a process that is built for both good days and bad days, good markets and bad markets, good decades and lost decades, then you can't deviate at the moment that's the most difficult. I know you talk about some really difficult times in history. You mentioned the lost decades, not the lost decade. The one that comes to mind first and foremost for me is, between 2000 and 2010, where if you just take the returns of the S&P, then you see no returns. But there's others, right? So you use Japan as a lesson. I know bonds in the 50s and 60s are also pretty much lost. What do you take from these lessons?
It's that first lost decade of this century is really seared into my memory because that's when I first came up in the industry, and I lived through it and I saw that happen, and it really I think so much of investing is really about like your personality and some of your experiences as well, like the things that you've lived through. And so living through that period and living through the great financial crisis and seeing how bad things can get really opened my eyes to the benefits of diversification. And it's funny because that basic premise of risk management is something that everyone has wanted to throw out the window for the past 10 years. Right? We had this 10-year
Absolutely.
period that showed people diversification can save you from this type of period. The S&P 500 went nowhere. It had two huge crashes, but all these other asset classes could have saved you, and you actually would have done okay if you had had some bonds and some emerging markets and some small caps or these other strategies. And now we've had this period where people just go, well, why wouldn't I just put all my money into large cap growth stocks or the NASDAQ 100 and call it a day because that's the only thing that works. And so people have to kind of learn these lessons. And a lot of them obviously weren't invested back then, didn't know that. So that's the kind of thing that you're right. Diversification doesn't protect you against like bad days or bad months or even bad years sometimes, right? It's about like the longer term cycles that you have to be protected against.
Absolutely. And I would mention there's something that you can read hundreds of chapters, hundreds of recaps. I love the book that came out last year, 1929, that gives you perspective on the Great Depression. Um, but living through those difficult moments yourself, whether you're a personal investor and you're opening your 401k statement, or you're an investment professional who's responsible for millions of dollars of your clients' portfolios, it is completely different to read about losses in a textbook or a personal narrative versus experiencing those losses firsthand. Um, I don't know if you could, you're talking about formative years that were the same as mine in that lost decade, but if you can, if you can compare and contrast what it's like to read about, like, for example, Japan just have going nowhere for multi decades, um, versus which we've read about but never experienced, versus the March of 2020 or something like that.
Yeah, I so there's this book called The Great Depression: A Diary, and this guy Benjamin Roth found his grandfather's diary from the Great Depression, and he wrote these little passages every couple months about what was going on and what it was like to live that period. And it's funny because most history books do a look back, and it's, with the benefit of hindsight, it's often easy to say, oh, of course, you would have bought back then when stocks got killed. Like I would have bought. It was obvious. But at the time, it's never obvious. And him giving notes to himself about how, hey, I think the worst is over. And then, of course, the worst wasn't over and things got worse. And and so, yes, I think it is. You want to like stand on the shoulders of giants sometimes and learn the mistakes of people in the past, but sometimes you have to just pay your own tuition, unfortunately, and learn those lessons and mistakes yourself. Uh, and I think that's like with every young investor. And I think coming out of the great financial crisis, a lot of young people wanted nothing to do with stocks. Remember, that was the story that millennials are giving up at the stock market, and that was a mistake. It seems like now we've gone to the other side of the boat, and a lot of young people are just taking so much risk. Right? They're day trading, they're speculating, and doing all those other things. And I think the pendulum does just kind of swing back and forth depending on the market cycle. And I guess the hope is you do learn those lessons when you're young and you don't have as much at stake, right? You have a smaller financial nest egg. And then when you're older, you've learned some lessons and you've gone through things and you realize uh, one big mistake in your older middle age retiree life can ruin your financial plan. And you don't want to make the worst possible error at the worst possible time.
Yeah, it's one thing if you open a statement and you had 100,000 and then it's down to 60. It feels entirely different, at least for some people, when you had a million and it went down to 600,000. It's just, those numbers are kind of spoken for in terms of a, game plan for sometime sooner. And that's where the role of financial planning comes in, I think. Um, and it's so interesting too when you think about what we've seen as investing professionals, where yes, the kind of populace has their trends, but also our financial industry caters to those trends, and in some cases creates a feedback loop of self affirmation. I remember, after 2009, it was like, this is the new normal. There's so much debt. We're going to never be able to trust equities again. Everything's overpriced way early after, kind of the recovery starting in 2009. And those that kind of deviated from their process and game plan and believed that really stunted the recovery and the, kind of bounce back that you could have participated in when it comes to portfolios.
Yeah, that's why the big thing I talk about in my book, I think I still this quote from Howard Marks, but he talks about like you don't try to predict, you try to prepare. And I think that's what the last 20 years has taught me, that so many people have tried to predict what happens next. And even the people who said they saw the financial crisis coming, most of them couldn't turn that side of their brain off and turn around the other way when it did snap back. And they stayed in that mindset and they couldn't get out of it. And I've just seen so many very intelligent people who have a very high IQ, who have a very good education, try to predict what's going to come next in the economy and the markets and be wrong time after time. And that's again why I think, yeah, you have a durable enough portfolio and durable enough plan to help you survive a wide range of outcomes without trying to predict what the outcome is going to be in advance. I never would have expected 10 years ago that the bull market would still be going on today and that things would keep snapping back. Who could have possibly predicted that, we'd have 9% inflation immediately turn into this AI revolution and that the earnings growth would still be kicking as strong as it is now in the stock market? I never could have possibly planned for that. And I think that's one of the things you have to do as an investor is have an open mind. And part of diversification is managing against the bad risks, but part of diversification is also opening yourself up and casting a wide enough net to take part in the winners when the winners are not, known to you in advance. And I think that's part of it too, is opening yourself up to both of those possibilities.
Well, I'm a collector of quotes by women about investing, not quotes about women investors, because if you ask AI, like, hey, give me some great quotes that women said, our voices are often masked, and it's like, oh, I'll tell you about women investing. So anyway, you had a quote from Maggie. Tell me if this is correct pronunciation. Mayer, and in the book, "Men Resist Randomness, Markets Resist Prophecy." And it's so difficult to explain to someone that you're an investment professional who doesn't believe in forecasting. But forecasting has cost portfolios more than anything I can think of when it comes to history, in a way to think this time is different. And it may be different, every time is different, but it's probably not the way that you're predicting, even if you're
Yeah,
really good.
we talk about history. She wrote one of my favorite books that I think it's one of the more underestimated uh, books on financial market history. It's called Bull, and it's a history of the bull market in the 1980s and 90s. But she also extended it to talk about what happened in the aftermath of the dot-com bubble blowing up and how people reacted to that situation ending. And of course, we know the current cycle right now is not going to last forever. I don't know how much longer it can go for. No one does, obviously, but I think you have to think about the other side of it. Um, and getting back to your women investor thing, I was just doing some research for someone on our team, and we are looking at the life expectancy things, and like the life expectancy for a man and a woman at 65, the woman's life expectancy is 3 to 4 years longer. And I don't think enough people in the financial advice industry are prepared for the fact that women are going to control the bulk of the money in the years ahead, because the baby boomer generation is, we've never had a demographic this large that's going to live this long that has this much money, right?
True, so true.
And the bulk of that money is going to go to women investors. And it's funny because all the data shows that women have more patience and they aren't as tempted to make changes to their portfolio as much, and they will stick with something. They won't just they don't speculate as much. Um, and I think it's fascinating how that will play out in the financial advice space. And I don't think enough people are ready for it yet.
It's so true. And it just, if we can go off on a tangent for a moment, there's another study that's kind of floating around on my women focused Instagram reels, which is that women receive like dumbed down financial advice. When you study what the financial plans or the investment strategies are advised to women, and I'm not including from women advisors to women, but all advisors make an assumption that they are not as sophisticated, which I think like any person can be less sophisticated when it comes to investing. And I've seen women and men who are less sophisticated, but there's an industry wide or professional um, default that goes to in some ways, you and I are both fans of simplicity. So, perhaps that's good, but it probably will also result in de-risked portfolios, which may result in different returns and outcomes
Uh,
and maybe limitations on financial resources. So there is so much room for these types of discussions. And I think like oxygen for women and men investing professionals to be having some looks in the mirror and talking about how we can be more prepared for that. Because I think the easy route that happens now is like, oh, look, if there's a few of us who are women financial planners, like you're for the women, but we're actually for people. And we need all of financial planners to kind of tune up for that coming wave of continuing wave of increasing financial control by females in the population.
yeah, it is funny. Like, there's all these stories about the great wealth transfer that's coming, right? And how much
Hmm.
money is going to go down to the next generation. But before that happens, most of the money is going to go down to the spouse, right? And I think you're right. It's women that are going to control it first, and no one's really planning for that wealth transfer.
Absolutely not. So it's so much more interesting. The waves of this is a completely different asset transfer than their parents' generation because you have defined contribution plans, 401ks, IRAs that have supersized wealth. You did not pass on your pension in the form of an inheritance when that person passed away, the pension terminated. And that's kind of how it worked back in the day. So there's a method to the madness when it comes to new eras of wealth for many Americans, and it's not your great grandfather's generational wealth transfer.
Yeah, it's also why the whole idea of transparency is so important, and including everyone in the conversation when you're talking about money.
Absolutely.
Uh, both generations, both spouses, but the whole household essentially, instead of just having one person be the point person. Because that, like I said, it's kind of morbid to talk about, but there's going to be a lot of death and dying in the years ahead because the baby boomer, there's such a large cohort of people
Hmm.
that dealing with that is just something that we're going to, as a society, have to kind of grapple with. That
So
there's
true.
70 million people that are reaching this age where they're not, they're riding it out in the sunset essentially. And those are conversations you have to have beforehand instead of after the fact.
Absolutely. And I find like we cater to working with people that are Gen X and older millennial, and they're whether it's dealing with an estate, but so many of them that I'm working with just anecdotally are getting, like firsthand checking on mom and dad, finding out they haven't filed taxes in a couple years. They're kind of masking the diminishing capacity. And then, you wake up and you're trying to figure out like, how is this working? And, grandpa was good with stocks. So he was self managing all the way through, which was great. The wealth was created, but now it needs to be tended to and managed. And it sure is helpful to have that conversation before the capacity issues present themselves.
Yeah, definitely.
Well, one of the other things I wanted to just ask you about. So the book is fantastic. You could pick it up if it had been written 10 years ago and if it was written 20 years in the future, and it would be relevant. So kudos on that, Ben. But I wondered, how do you take the lessons from Risk and Reward and apply them to the world today? I know so many people that are like appreciative of the positive returns in the market, but also pessimistic about the future, concerned, fearful, etc. What lessons do you take to apply to today's world?
Yeah, I sometimes people ask me like, "How do you come up with stuff to write for your blog?" And what I say is that I try to have like this 10,000-foot worldview of this philosophy, and then apply it to today, right? Like what's going on to today, and that's why it's like a more like you said, a basic building block type of thing. And I think that it still rings true to no matter what is going on. And I think there's certain investors that, and this was especially true coming out of the great financial crisis, that latched onto the bad stuff and they couldn't get out of, like, they were investing from the fetal position and way too conservative. And now you've probably got some people who are on the other side of the boat who've gone, "Oh my gosh, things are going so good, they're never going to get bad again." It is funny though. I do think anecdotally from the people that we talk to, a lot of clients have, I think a lot of people have learned their lesson because we have clients coming to us who have huge gains in these stocks that they put in 10 years ago, right? Hey, I put money in Nvidia, I put money in Tesla or Apple or one of these stocks, and it made me a ton of money. And I know I need to diversify. So I don't think it's like there's all these maniacs running around just assuming the good times are going to last forever. I think a lot of people do recognize the fact that like diversification is a form of risk management and that it makes sense, especially in times like this when you don't know what the future holds, especially when the future is always uncertain, but in times of technological change, and we're dealing with geopolitical situations, plus this huge innovation boom in AI, and what is it going to mean about the future? And it seems like uncertainty is heightened now. I guess the point is that there's always this irreducible level of uncertainty about the future, and you're never going to get rid of that. And that's the whole point of like having to step off into the void a little bit and accept risk. And it's really about knowing yourself and like how much you can really take. I'd say in the book, like the good plan you can stick with is way superior to the perfect plan you can't stick with.
Yeah,
And I think
the
that's part
chapter
of it.
on the perfect portfolio, unfortunately, the answer is it's up to you, your emotions, your approach to risk, what you can take. I always say that the success of a financial planner or an investment manager is the batting average of their clients when you go through difficulties. So, what is the batting average for you staying in the allocation that you've chosen? Um, in March of 2020 or in 2022 when it was a very difficult investing market. It was just brief. And so if you review your investment portfolio and you navigated through and you're on the same place on the other side, you're not bouncing around from year to year. That is a good batting average. And I guess if you never change it and you never look, then the question could be, could you take more risk? But otherwise, if you're always changing, then you probably taken on too much.
Yeah, no, yeah, I think that's it. You're right. The batting average is a great analogy, and I think you have to figure out whether you're the kind of person who wants to swing for home runs, but you could strike out, or you're the kind of investor who's okay taking singles and doubles and just getting on base.
Well, speaking of batting averages, I'm gonna bounce to a different sports analogy. I'm a huge Michigan basketball fan. I don't know if you where your allegiances lie when it comes to
No,
the
I'm
state.
also a Michigan fan. I took my kids to Chicago for one of the regional final games, so we're big Go Blue fans in our household too.
The times are good for the men's and women's basketball team. But when I read your last chapter, the epilogue, 20 Things I Believe About Investing, I was reminded of something that I learned about the way Dusty May coaches for men's basketball at University of Michigan. He has a preference for how you shoot if you're his player. Number one preference, get to the free throw line, get those free shots, uncontested shots. Number two is layups or close to the basket dunks. They're super high percentage. And number three is three pointers. So when you look at the visual statistics of his team shooting, there's such discipline from the team. Nobody is shooting mid-range jumpers. They're lower probability. You get a 50% bump if you make a shot from the three versus if you make that to mid-range, which has lower probability. And the discipline of, do not take that shot if you're open in the middle, really was part of their success. And he taught that to a team that a lot of the roster was new to him, just in that 9-month period. When I read your chapter, which I think is golden, on 20 Things I Believe About Investing, I'm reminded of that discipline. I think like every great investor, personal or professional, needs that list of things that you're going to commit to and endure. And I just wonder how you developed the list, and maybe we could talk about a couple of the points.
Yeah, I think it's kind of everything that I've been trying to figure out about myself and about investing in the markets. And I just think that the markets are like this huge laboratory for understanding human emotions, and that's the biggest part of it. Obviously, everyone can look at the data now, and the data is pretty easy, much easier to come by. But I think understanding yourself and figuring out what your actual beliefs are allows you to, like you said, swat away those mid-range jumpers if that's not on your plan. That's the hardest part. Josh
Hmm.
Brown, who I work with, always says that a good financial advisor is like a bouncer at a club, standing behind the velvet rope and like not letting in stuff for your portfolio
Junk.
most of the time, turning it away. Yeah, turning it away and only letting in the things that like meet your criteria. But you have to have a criteria in the first place, otherwise you're totally lost.
Absolutely. I think like your number one on the list is I believe simple beats complex. And Um, I think simplicity, whether it's in your financial plan, simplicity definitely in your investment process. We have a decision rule in our investment process that you have to have a reasonable case that you could beat, the market capped index in order to make it into the portfolio. Otherwise, the index is just fine and a heck of a lot cheaper in most cases. And simplifying wherever possible is a great way to get started when it comes to kind of dictums that can really help you to be successful as an investor.
Yeah, and easier to understand. You know what you own and why you own it. Yes, you're right. That index should be your anchor for, and it's kind of like a benchmark comparison too for the rest of the stuff in your portfolio. If you're going to pick stocks, if you're going to pick an actively managed fund, you compare it to that index, and that's kind of your benchmark. Like, was all the time and effort and higher fees and higher costs and more transactions, was it actually worth it in the end?
Absolutely. And I think a lot of the rest of your, kind of 20 beliefs are behavioral and psychological. Can you just, I know you emphasize this throughout the book, but just tell us in your own words how important that psychology is to being successful over time as an investor.
Yeah, I when I first got into the business, I was working on the institutional side of things, and I was in the room with a lot of very smart people, very high IQ, very well educated. They had a lot of letters after their names, MBAs and CFAs and PhDs and all these things. But I found a lot of those people tried too hard to outsmart the market, and I
Hmm.
realized that they didn't have any. They were so smart, they didn't have enough self awareness or self control. And I realized
Or
like,
maybe
oh, okay,
humility.
yeah, humility, yes, and yeah, and the ability to admit, like, I don't know sometimes. Like, I
Hmm.
never heard any of these people say, I don't know, or we're underperforming right now because this is just not the right time for our strategy. It was always excuses, and the market just isn't aware of our strategy yet or whatever. It's going to happen, and so I think like I learned that self control and self awareness, and that matters a lot more. And yeah, the ability to say I don't know, and sometimes say I'm not smarter than the market. The market is smarter than me. All these millions and millions of opinions that make up the prices. Maybe I'm not. Maybe I can't outsmart it. That's not to say the market is always right, but I think, yeah, that having some humility and self awareness is huge as an investor, because uh, I had a boss who told me, like, don't like you're going to be surprised in the market. Just don't be surprised that you are surprised by what happens.
So true. And, speaking of batting averages, nobody bats 1,000. In fact, if you can just, get up and participate and, kind of get the market's numbers day to day, it's kind of going to look like a coin toss from
Right.
one day to the next. But over time, that's where, if you're patient, if you avoid being reactive, if you avoid those shiny objects, that's where you start to, kind of feel the weight of the building of wealth and the results. And you can never get there if you're just looking for the next hot stock.
Yeah, and the hard part is it takes time. You do have to be patient. And that's hard for a lot of people these days because everything in our society is on demand now, right?
Yeah, it's
Food and movies and
milliseconds.
TV shows. Yeah.
Hmm.
Everything is right there.
So true. Well, Ben, where can people find the book? I'm sure everywhere.
Yeah, Harriman House published it for me. They did a great job. I actually read the audiobook myself. I figured I'd try it, did that for the first time since I do the podcast. So it's in Kindle and paperback and audio and Amazon and Barnes and Nobles and all the places.
Well, congratulations on your audio debut as well. And thank you so much for joining us. I love the book.
Yeah, thanks for having me.
Thank you for listening to the Women's Money Wisdom podcast. If you found value in this episode, the best way that you can support the podcast is to forward an episode to a friend or leave a review. Go to proplan.com and the podcast link to get all the resources and links mentioned. This presentation by Pearl Planning is intended for general information purposes only. No portion of this presentation serves as a receipt of or a substitute for personal investment advice from Pearl Planning or any other investment professional of your choosing. Copies of Pearl Planning's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or on our website platform at pearlplan.com. The information that we share is meant to educate and inspire, not serve as personalized financial advice. Everyone's situation is unique, so be sure to consult with your own financial professional for guidance that fits your life. And just so you know, The opinions shared in this podcast are Melissa's own and those of her guests. They don't necessarily represent any organizations with which Melissa is affiliated. For more important disclosures, please go to our webpage at proplan.com.